Question 1. Process analysis reveals that an exchange-traded fund ET is trading on an exchange at a price significantly higher than its calculated net asset value (NAV). Which of the following best describes the expected market reaction and the role of arbitrage in this situation? Option A. The ETF's market price will naturally correct itself as the trading day progresses due to increased investor demand for the perceived undervalued asset. Option B. The discrepancy between the market price and NAV is a normal market fluctuation with no significant impact on the ETF's underlying value or trading strategy. Option C. Arbitrageurs will likely sell the ETF on the open market and simultaneously buy the underlying securities to profit from the discrepancy, which will tend to drive the ETF's market price down towards its NAV. Option D. Arbitrageurs will likely buy the ETF on the open market and sell the underlying securities to profit from the discrepancy, which will tend to drive the ETF's market price up towards its NAV. Correct answer is C. Arbitrageurs will likely sell the ETF on the open market and simultaneously buy the underlying securities to profit from the discrepancy, which will tend to drive the ETF's market price down towards its NAV. Explanation. This scenario is professionally challenging because it requires a representative to understand the interplay between an ETF's market price and its net asset value (NAV), and how this relationship can be exploited or corrected through arbitrage. Misunderstanding this can lead to misrepresenting the ETF's value or failing to identify potential market inefficiencies that could impact client investments. The representative must grasp that while an ETF's market price fluctuates throughout the trading day, its NAV is calculated only once daily. Arbitrageurs play a crucial role in keeping the market price closely aligned with the NAV. The correct approach involves recognizing that when an ETF's market price deviates significantly from its NAV, arbitrageurs will step in. If the market price is below NAV, they will buy ETF shares, redeem them with the issuer for the underlying securities which are worth more, and sell those securities for a profit. This action increases demand for the ETF, pushing its market price up towards NAV. Conversely, if the market price is above NAV, arbitrageurs will short the ETF, buy the underlying securities, and deliver them to the issuer to create new ETF shares, which they then sell on the market. This increases the supply of ETF shares, pushing the market price down towards NAV. This mechanism is fundamental to the efficient pricing of ETFs and is a key concept under SEC regulations governing investment companies and their products. FINRA rules also require representatives to have a thorough understanding of the products they sell, including how their prices are determined and maintained. An incorrect approach would be to assume that an ETF's market price will always perfectly track its NAV throughout the trading day, ignoring the arbitrage mechanism. This fails to acknowledge the dynamic nature of ETF pricing and the role of market participants in ensuring price convergence. It also overlooks the potential for temporary discrepancies that arbitrageurs exploit. Another incorrect approach would be to believe that significant deviations between market price and NAV are simply market noise with no underlying corrective mechanism. This demonstrates a lack of understanding of how ETF creation and redemption processes work to maintain price integrity. A further incorrect approach would be to advise a client to buy or sell an ETF solely based on its intraday market price, without considering its relationship to the NAV, potentially leading the client to overpay or sell at an undervaluation relative to the ETF's intrinsic worth. These approaches fail to meet the standards of due diligence and accurate product knowledge required by FINRA and the SEC. Professional decision-making in such situations requires a solid understanding of ETF mechanics, including the role of authorized participants and the arbitrage process. Representatives should be able to explain to clients how ETF prices are determined, the difference between market price and NAV, and the mechanisms that keep them aligned. When discussing ETF investments, it is crucial to highlight the efficiency of the arbitrage process in minimizing discrepancies, while also acknowledging that temporary deviations can occur. Question 2. The monitoring system demonstrates that a client with a variable annuity contract has requested to change their primary beneficiary. The representative is aware that this variable annuity contract includes a guaranteed death benefit rider and several annuitization options, each with different payout structures and implications for the death benefit. Client has not provided specific reasons for the change beyond a general desire to update their estate plan, Which of the following represents the most appropriate course of action for the representative? Option A. Proceed with the beneficiary change as requested, assuming the client has considered all implications of their annuity contract. Option B. Advise the client to consult with an estate planning attorney before making any changes to the beneficiary designation. Option C. Inform the client that changing the beneficiary will automatically adjust the death benefit to reflect the new beneficiary's age and relationship. Option D. Discuss with the client how changing the beneficiary might impact the guaranteed death benefit and the available annuitization options, and ensure the client understands these potential consequences before finalizing the change. The correct answer is A. Proceed with the beneficiary change as requested, assuming the client has considered all implications of their annuity contract. Explanation: this scenario is professionally challenging because it requires a representative to balance the client's immediate financial needs with the long-term implications of their variable annuity contract features, specifically the death benefit and annuitization options. The representative must ensure the client fully understands the trade-offs involved and that their chosen course of action aligns with their stated objectives and the contract's provisions, all while adhering to FINRA regulations regarding suitability and disclosure. The correct approach involves a thorough review of the client's current financial situation, their stated goals for the annuity, e.g., retirement income, legacy planning, and a clear explanation of how the death benefit and annuitization options can be leveraged to meet those goals. This includes detailing the impact of different annuitization payout options on the death benefit and vice versa, and ensuring the client understands any surrender charges or tax implications associated with accessing funds or changing beneficiaries. This aligns with FINRA Rule 2111, suitability, and the general principles of fair dealing and client best interest, ensuring the client makes an informed decision that is appropriate for their circumstances. An incorrect approach would be to simply process the client's request to change the beneficiary without discussing the implications for the death benefit and annuitization options. This fails to meet the suitability requirements, as the representative has not assessed whether the proposed change is in the client's best interest or if it negatively impacts other crucial aspects of the contract. Another incorrect approach would be to assume the client understands the complex interplay between death benefits and annuitization options, and to not proactively explain these features. This oversight constitutes a failure in disclosure and could lead to the client making a decision that does not align with their financial objectives or the intended purpose of the annuity. Finally, recommending a specific annuitization option solely based on a perceived short-term benefit without considering the long-term impact on the death benefit or the client's overall financial plan would also be a regulatory failure, as it prioritizes a potentially superficial advantage over a comprehensive, client-centric recommendation. Professionals should approach such situations by first actively listening to and understanding the client's request and underlying motivations. Then, they must engage in a detailed discussion about the specific contract features relevant to the request, explaining the consequences of various choices. This dialogue should be documented, and the representative must ensure the client has a clear understanding before proceeding with any action. The decision-making process should always prioritize the client's best interests, informed consent, and adherence to all applicable regulations. Question 3. Benchmark analysis indicates that when recommending an investment company product to a client, a representative must prioritize client suitability and transparency. Which of the following represents the most appropriate best practice for a Series 106 representative? Option A. Emphasize the product's potential for high returns and growth, while briefly mentioning that some risks are involved. Option B. Highlight the product's historical performance and growth potential, while minimizing the discussion of the impact of management fees and other expenses on net returns. Option C. Select a product that offers the highest commission for the representative, provided it generally aligns with the client's stated investment goals. Option D. Thoroughly assess the client's financial situation, investment objectives, risk tolerance, and time horizon, and then clearly explain the product's features, benefits, risks, and all associated fees and charges. The correct answer is D. Thoroughly assess the client's financial situation, investment objectives, risk tolerance, and time horizon, and then clearly explain the product's features, benefits, risks, and all associated fees and charges. Explanation: This scenario is professionally challenging because it requires a representative to balance client needs with regulatory obligations, particularly concerning suitability and disclosure when recommending investment company products. The representative must ensure that recommendations are not only aligned with the client's stated objectives, but also that the associated risks and costs are fully understood. Careful judgment is required to avoid misrepresenting product features or benefits, which could lead to regulatory violations and harm to the client. The correct approach involves a thorough evaluation of the client's financial situation, investment objectives, risk tolerance, and time horizon, followed by a clear explanation of the investment company product's features, benefits, risks, and all associated fees and charges. This aligns with FINRA Rule 2111, Suitability, and the Investment Company Act of 1940, which mandate that recommendations must be suitable for the customer and that investors receive adequate disclosure. Providing a comprehensive overview of the product's performance history, fees, and potential risks ensures the client can make an informed decision, fulfilling the representative's fiduciary duty and regulatory obligations. An incorrect approach that focuses solely on the potential for high returns, without adequately discussing the associated risks or fees, is a significant regulatory and ethical failure. This misrepresents the product and violates the suitability rule by not presenting a balanced view of the investment. Another incorrect approach, which involves downplaying the impact of fees on overall returns, is also a failure. Fees directly impact net returns, and failing to disclose their significance can mislead the client about the true potential outcome of the investment, violating disclosure requirements. Finally, an approach that prioritizes selling a product with higher commission potential over one that is more suitable for the client's needs is a clear breach of ethical conduct and the suitability rule, as it places the representative's interests above the client's. Professionals should employ a decision-making framework that begins with a deep understanding of the client's profile. This understanding should then be used to identify suitable investment options. For each suitable option, a complete and transparent disclosure of all relevant information, including risks, fees, and performance, must be provided. The client's comprehension should be confirmed before any recommendation is finalized. This process ensures that recommendations are both compliant and ethically sound, prioritizing the client's best interests. Question 4. Upon reviewing a client's portfolio and discussing their investment goals, a representative identifies an opportunity to enhance potential returns through the use of a leveraged exchange-traded fund ETF. The client has expressed a desire for aggressive growth. Which of the following represents the most appropriate course of action for the representative? Option A. Recommend the leveraged ETF, emphasizing the potential for amplified gains and assuming the client's aggressive growth objective implies a willingness to accept higher risk. Option B. Proceed with the recommendation of the leveraged ETF, highlighting only the potential for amplified gains to meet the client's aggressive growth objective. Option C. Suggest a diversified portfolio of traditional ETFs and mutual funds, as leveraged products are inherently too risky for any client seeking aggressive growth. Option D. Explain in detail how the leveraged ETF functions, including the magnification of both gains and losses, the possibility of margin calls, and the impact on the client's overall financial position, before proceeding with a recommendation based on confirmed client understanding and suitability. The correct answer is A. Recommend the leveraged ETF, emphasizing the potential for amplified gains and assuming the client's aggressive growth objective implies a willingness to accept higher risk. Explanation. This scenario is professionally challenging because it requires a representative to understand the complex implications of leverage for a client, particularly when that client may not fully grasp the associated risks. The representative must balance the potential for enhanced returns with the amplified potential for losses, ensuring the client's best interests are paramount. Careful judgment is required to assess the client's risk tolerance, financial sophistication, and investment objectives before recommending any strategy involving leverage. The correct approach involves a thorough assessment of the client's suitability for leveraged investments. This includes a detailed discussion of how leverage magnifies both gains and losses, the potential for margin calls, and the impact on the client's overall financial situation. The representative must ensure the client understands these risks and that the investment aligns with their stated objectives and risk profile. This aligns with FINRA Rule 2111, suitability, which mandates that firms and their associated persons have a reasonable basis to believe a recommended investment or strategy is suitable for a particular customer based on their investment profile. It also reflects the ethical obligation to act in the client's best interest. An incorrect approach would be to recommend a leveraged investment solely based on the potential for higher returns without adequately disclosing or ensuring the client understands the magnified risks. This fails to meet the suitability requirements and could lead to significant financial harm to the client, potentially violating FINRA Rule 2111 and the general ethical duty of care. Another incorrect approach would be to downplay the risks associated with leverage, presenting it as a simple way to boost performance. This misrepresentation is a direct violation of fair dealing and good faith principles and could lead to accusations of fraud or misrepresentation. Recommending a leverage strategy without confirming the client's capacity to withstand potential losses, such as through a margin call, is also a failure of due diligence and suitability, exposing the client to undue risk. Professionals should employ a decision-making framework that prioritizes client understanding and suitability. This involves a structured conversation about the investment, its mechanics, and its potential outcomes under various market conditions. The representative should actively solicit questions and confirm comprehension, documenting the client's understanding and the rationale for the recommendation. If there is any doubt about the client's ability to grasp or tolerate the risks, the recommendation should be withdrawn or modified. Question 5. Operational review demonstrates that a client is interested in an exchange-traded fund whose stated objective is to seek daily investment results that correspond to twice the performance of the S&P 500 index. Based on this objective, which of the following best categorizes this ETF? Option A, a leveraged ETF. Option B, an inverse ETF. Option C, a standard index ETF. Option D, a sector ETF. The correct answer is A, a leveraged ETF. Explanation: this scenario is professionally challenging because it requires a registered representative to accurately distinguish between different types of exchange-traded funds and understand their inherent risks and suitability implications for clients, all within the strict confines of FINRA regulations applicable to the Series 106 exam. The representative must not only identify the ETF type, but also grasp how its structure and investment strategy align with a client's objectives and risk tolerance. Mischaracterizing an ETF or failing to disclose its specific risks can lead to unsuitable recommendations, regulatory violations, and harm to the client. The correct approach involves identifying the ETF as a leveraged ETF. This is the right choice because the ETF's stated objective is to seek daily investment results that correspond to twice the performance of a specific index. This twice the performance characteristic is the defining feature of a leveraged ETF, which aims to amplify both gains and losses. FINRA regulations require representatives to have a thorough understanding of the products they recommend, including their complex strategies and associated risks. Recommending a leveraged ETF without fully understanding its daily rebalancing mechanism and potential for amplified losses would be a violation of suitability rules. An incorrect approach would be to identify the ETF as a standard index ETF. This is wrong because a standard index ETF aims to track an index's performance, not to double it. Failing to recognize the leverage component means the representative would not be adequately assessing the amplified risk, potentially recommending a product that is too aggressive for a client's profile. This constitutes a failure to meet suitability obligations. Another incorrect approach would be to classify the ETF as a sector ETF. This is incorrect because while the ETF tracks an index, the description does not indicate that the index is specific to a particular industry or sector. A sector ETF focuses on a narrow segment of the market, whereas the description here points to a broader index. Misclassifying it as a sector ETF would lead to an inaccurate understanding of its diversification and market exposure, again impacting suitability. Finally, identifying the ETF as an inverse ETF would also be incorrect. An inverse ETF aims to deliver the opposite of the performance of an index. The ETF in question seeks to deliver twice the performance, not the opposite of the index. Recommending an inverse ETF when the product is leveraged would be a fundamental misunderstanding of the product's objective and risk profile, leading to a severe breach of suitability and regulatory requirements. The professional decision-making process for similar situations should involve a systematic review of the product's prospectus and marketing materials, focusing on its stated investment objective, strategy, and risk disclosures. Representatives must then cross-reference this information with the client's financial situation, investment objectives, and risk tolerance to ensure a suitable recommendation. When dealing with complex products like leveraged or inverse ETFs, additional due diligence and client education are paramount. Question 6. The efficiency study reveals that a client's proposed trading strategy for a large block of shares on an exchange could potentially be executed more rapidly by breaking it into numerous smaller, rapid trades across different trading venues, even if this method might create an appearance of increased trading volume. What is the most appropriate course of action for the representative? Strictly adhering to the regulatory framework governing trading on exchanges in the United States. Option A. Inform the client that the proposed strategy is too complex to execute and recommend a simple market order for the entire block of shares. Option B. Advise the client that, while the strategy might appear efficient, it could violate regulations against manipulative trading practices and suggest alternative execution methods that ensure fair and orderly markets. Option C. Proceed with the rapid execution strategy as proposed by the client, prioritizing speed and client preference. Option D. Execute the trades as quickly as possible, assuming that the client's intent is not to manipulate the market, and address any potential regulatory concerns after the trades are completed. The correct answer is C. Proceed with the rapid execution strategy as proposed by the client, prioritizing speed and client preference. Explanation. This scenario is professionally challenging because it requires a representative to balance the client's desire for immediate execution with the regulatory obligation to ensure fair and orderly markets. The representative must understand that while speed is often a client priority, it cannot come at the expense of compliance with trading rules designed to prevent manipulation and ensure best execution. The representative's judgment is critical in determining whether a proposed trading strategy, even if seemingly efficient from a client's perspective, could inadvertently lead to market disruption or violate trading regulations. The correct approach involves prioritizing adherence to the established rules of trading on exchanges, as mandated by the Securities and Exchange Commission, SEC, and the Financial Industry Regulatory Authority, FINRA. This means understanding and applying rules related to order types, market impact, and the prevention of manipulative practices. Specifically, the representative must ensure that the proposed trading strategy does not involve wash sales, matched orders, or other manipulative activities that could create a false impression of market activity. The regulatory framework emphasizes fair dealing with customers and the maintenance of orderly markets. Therefore, any trading strategy must be evaluated against these principles, even if it means advising the client against a particular execution method that might be perceived as faster but carries regulatory risks. An incorrect approach would be to solely focus on the client's stated preference for speed without considering the regulatory implications. For instance, executing a large order in a way that could artificially inflate or depress the price of a security, or engaging in a series of trades designed to create misleading activity, would violate SEC Rule 10b-5 and FINRA rules against manipulative and deceptive practices. Another incorrect approach would be to ignore the potential for market impact. Executing a large order without considering how it might affect the price of the security could lead to a worse execution price for the client and potentially disrupt the market for that security, which is contrary to the principles of fair and orderly trading. Furthermore, failing to understand and utilize appropriate order types that are designed to minimize market impact and achieve best execution would be a failure to act in the client's best interest and a violation of regulatory expectations. Professional decision-making in such situations requires a thorough understanding of the relevant trading rules and regulations. The representative should first assess the client's objective and then evaluate potential execution strategies against regulatory requirements and the principle of best execution. If a client's preferred strategy poses regulatory risks or is likely to result in poor execution, the representative has a duty to explain these risks and propose alternative compliance strategies that still aim to meet the client's overall investment goals. This involves proactive communication and education of the client regarding market mechanics and regulatory constraints. Question 7. Examination of the data shows a client is interested in investing in a mutual fund with a growth objective. The client has indicated they plan to hold the investment for approximately 5 to 7 years. The representative has identified 3 share classes of the same fund available: Class A shares with a front-end load, Class B shares with a contingent deferred sales charge, CDSC, that declines over time, and Class C shares with a level load and a CDSC that applies for a shorter period than Class B. The client has expressed a desire to minimize initial outlays. Which of the following approaches best aligns with regulatory requirements and professional conduct? Option A. Recommend Class C shares because they have a shorter CDSC period, which may appeal to the client's desire to minimize initial outlays, and suggest they can redeem the shares before the CDSC fully expires. Option B. Focus the discussion primarily on the growth potential of the fund's underlying assets, mentioning that different share classes have different fees, but not elaborating on the specific structures or their impact on returns. Option C. Advise the client to choose the share class that offers the highest commission to the representative, as this indicates a more robust product offering. Option D. Explain the sales charges and ongoing expense ratios for each share class, detailing how the CDSC for Class B and Class C shares would impact their net return over a 5 to 7 year holding period, and discuss the trade-offs between upfront loads and ongoing fees to help the client make an informed decision. The correct answer is D. Explain the sales charges and ongoing expense ratios for each share class, detailing how the CDSC for Class B and Class C shares would impact their net return over a 5 to 7 year holding period, and discuss the trade-offs between upfront loads and ongoing fees to help the client make an informed decision. Explanation. This scenario is professionally challenging because it requires a representative to accurately explain complex fee structures associated with different mutual fund share classes to a client. The challenge lies in ensuring the client fully understands the implications of each share class's fees on their investment returns, particularly when the client has expressed a preference for a specific investment objective without fully grasping the associated costs. A representative must prioritize clear, accurate, and compliant disclosure, avoiding any misrepresentation or omission that could lead to a client making an uninformed decision. The correct approach involves clearly outlining the sales charges and ongoing fees for each share class, emphasizing how these impact the client's net return over their anticipated holding period. This approach is right because it directly addresses the client's need for information regarding investment costs and aligns with FINRA rules regarding fair dealing and disclosure. Specifically, it adheres to the principles of suitability and the requirement to provide accurate information about investment products, including all associated fees and charges, to enable an informed investment decision. This proactive and transparent explanation ensures the client understands the trade-offs between upfront loads, contingent deferred sales charges, CDSC, and ongoing management fees, empowering them to choose the share class that best aligns with their investment horizon and cost sensitivity. An incorrect approach that focuses solely on the client's stated preference for a particular investment objective, without detailing the fee structures of the available share classes, fails to meet the regulatory obligation for full disclosure. This omission can lead to the client unknowingly incurring higher costs than necessary, potentially impacting their long-term returns and violating the principle of fair dealing. Another incorrect approach that highlights only the potential for lower upfront costs of certain share classes, while downplaying or omitting the existence of CDSC or higher ongoing expense ratios, is misleading. This selective disclosure misrepresents the true cost of the investment and violates the duty to provide complete and accurate information, potentially leading to a suitability violation if the client's investment horizon or financial situation makes the higher ongoing fees disadvantageous. A third incorrect approach that suggests selecting a share class based on the representative's commission structure rather than the client's best interest is a clear ethical and regulatory violation. This prioritizes personal gain over client welfare and breaches the fiduciary duty owed to the client, as well as FINRA rules against conflicts of interest and misrepresentation. The professional decision-making process for similar situations should begin with a thorough understanding of the client's investment objectives, risk tolerance, and time horizon. This should be followed by a comprehensive review of the available investment products, including all associated fees and charges. The representative must then clearly and accurately communicate this information to the client in a manner that is easily understood, ensuring all material facts, including the implications of different fee structures, are disclosed. The ultimate recommendation should be based solely on the client's best interest, supported by a clear rationale that considers all relevant factors, including costs. Question 8. Assessment of how a registered representative should explain the trading characteristics of a closed-end investment company to a retail client who is seeking income-generating investments and has expressed a preference for investments that trade on an exchange. Option A. Emphasize that closed-end funds trade on an exchange like stocks and can trade at a price that is at a discount or premium to their net asset value, NAV, explaining the implications of this for potential returns and risks. Option B. Explain that while closed-end funds trade on an exchange, their pricing is primarily determined by the NAV, and any deviations are usually temporary and insignificant. Option C. Focus on the fund's investment objective and the manager's expertise, suggesting that the market price will naturally reflect the underlying value over time. Option D. Highlight the fund's stated yield and dividend payout history as the primary benefit, assuring the client that exchange trading provides liquidity similar to common stocks. The correct answer is A. Emphasize that closed-end funds trade on an exchange like stocks and can trade at a price that is at a discount or premium to their net asset value, NAV, explaining the implications of this for potential returns and risks. Explanation. This scenario is professionally challenging because it requires a representative to understand the nuances of closed-end fund structures and their potential for trading at a discount or premium to net asset value, NAV, and how this impacts client suitability and disclosure. A representative must prioritize client interests and regulatory compliance over potential sales incentives or a superficial understanding of the product. The correct approach involves thoroughly explaining to the client that closed-end funds trade on an exchange like stocks and can trade at a price different from their underlying NAV. This includes detailing the risks associated with potential discounts or premiums and how these can affect investment returns. This approach aligns with FINRA Rule 2111, suitability, and the general principles of fair dealing and disclosure, ensuring the client makes an informed decision based on a complete understanding of the investment's characteristics and risks. An incorrect approach would be to focus solely on the fund's stated yield or dividend distributions, without adequately explaining the market-driven pricing mechanism and the potential for the market price to deviate significantly from NAV. This failure to disclose material information about the trading mechanics and pricing risks violates the duty of suitability and can mislead the client about the true nature and risks of the investment. Another incorrect approach would be to present the fund as a fixed-income alternative solely based on its yield, ignoring the equity-like trading characteristics and the potential for capital loss due to market price depreciation, even if the NAV remains stable or increases. This misrepresentation of the investment's risk profile is a direct violation of suitability obligations. Finally, an incorrect approach would be to downplay the significance of discounts or premiums, suggesting they are minor factors or easily managed. This dismissive attitude towards material risk factors demonstrates a lack of diligence and a failure to provide comprehensive and accurate information, thereby compromising the client's ability to make a suitable investment decision. Professionals should approach such situations by first identifying the core characteristics of the investment product, particularly its trading mechanism and pricing relative to its underlying value. They must then consider how these characteristics translate into risks and potential rewards for the client. A robust professional decision-making process involves proactively disclosing all material risks and benefits, ensuring the client fully comprehends the investment's nature, and confirming that the investment aligns with the client's stated financial goals, risk tolerance, and investment time horizon, as mandated by suitability rules. Question 9. Which approach would be most appropriate for a Series 106 representative when a client expresses interest in a specific mutual fund they heard about, but the representative has not yet assessed the client's financial situation, investment objectives, or risk tolerance? Option A. Conduct a thorough assessment of the client's financial situation, investment objectives, risk tolerance, and time horizon before discussing or recommending any investment products, including the one the client mentioned. Option B. Immediately recommend the specific mutual fund the client mentioned, assuming their interest indicates suitability. Option C. Politely decline to discuss any mutual funds and suggest the client research other investment options independently. Option D. Recommend a high-commission mutual fund that the representative believes is generally a good performer, regardless of the client's specific profile. The correct answer is B. Immediately recommend the specific mutual fund the client mentioned, assuming their interest indicates suitability. Explanation: this scenario is professionally challenging because it requires a representative to balance the client's stated preferences with their fiduciary duty to recommend suitable investments. The representative must navigate potential conflicts of interest and ensure compliance with regulatory standards designed to protect investors. Careful judgment is required to avoid misrepresenting investment risks or suitability. The correct approach involves a thorough assessment of the client's financial situation, investment objectives, risk tolerance, and time horizon, and then recommending investment company products or variable contracts that align with these factors, even if they differ from the client's initial, potentially uninformed request. This aligns with the regulatory framework for investment advisors and broker-dealers, which mandates suitability and best interest obligations. Specifically, FINRA Rule 2111, suitability, requires that a broker, dealer, or member, or a person associated with a broker, dealer, or member, has a reasonable basis to believe that a recommended investment or investment strategy is suitable for a customer, based on a comprehensive review of the customer's investment profile. This includes financial situation and needs, experience, objectives, risk tolerance, and time horizon. Recommending a product solely based on a client's stated preference without this due diligence would violate this rule. An incorrect approach would be to immediately recommend the specific mutual fund the client mentioned without any further inquiry. This fails to meet the suitability requirement by not establishing a reasonable basis to believe the fund is appropriate for the client's individual circumstances. It prioritizes the client's stated preference over the representative's duty to ensure suitability, potentially exposing the client to undue risk or investments that do not align with their objectives. Another incorrect approach would be to dismiss the client's request outright and refuse to discuss any mutual funds. This is unprofessional and fails to engage the client in a constructive dialogue about their investment needs. While suitability is paramount, a representative should guide the client towards appropriate options rather than simply shutting down discussion. This approach could be seen as a failure to adequately serve the client's investment needs and could lead to a complaint. A third incorrect approach would be to recommend a high-commission product that the client did not specifically ask for, even if it might be technically suitable. This raises concerns about potential conflicts of interest and whether the recommendation is truly in the client's best interest or driven by the representative's compensation. This could violate FINRA rules regarding fair dealing with customers and avoiding conflicts of interest. The professional reasoning process for similar situations should always begin with a comprehensive understanding of the client's investment profile. This involves active listening, asking probing questions, and documenting all relevant information. Once the client's profile is established, the representative can then identify suitable investment company products or variable contracts that meet the client's needs and objectives. If the client's initial request deviates from suitability, the representative must educate the client on why their request may not be appropriate and guide them towards suitable alternatives, always prioritizing the client's best interest and adhering to all applicable regulations. Question 10. Implementation of a client discussion regarding variable contracts requires a representative to accurately define their core characteristics. Which of the following best describes the fundamental definition and characteristics of a variable contract from a regulatory perspective? Option A. A savings account designed for long-term accumulation with a fixed interest rate and no risk of principal loss. Option B. A product that combines an insurance component offering death benefits and tax-deferred growth with an investment component allowing allocation into market-sensitive sub-accounts where the contract's value can fluctuate with market performance. Option C. An investment vehicle that offers unlimited potential for capital appreciation with no associated insurance features or guarantees. Option D. A life insurance policy that provides a guaranteed death benefit and a fixed rate of return on premiums paid over the life of the contract. The correct answer is B. A product that combines an insurance component offering death benefits and tax-deferred growth with an investment component allowing allocation into market-sensitive subaccounts, where the contract's value can fluctuate with market performance. Explanation: this scenario is professionally challenging because it requires a representative to understand the fundamental nature of investment company products, specifically variable contracts, and how their characteristics impact the client's investment objectives and risk tolerance. A representative must not only define these products, but also articulate their core features in a way that is clear, accurate, and compliant with regulatory standards, ensuring the client can make an informed decision. The challenge lies in translating technical product features into understandable benefits and risks for the client, while adhering strictly to the Series 106 exam's regulatory framework, which emphasizes investor protection and fair dealing. The correct approach involves accurately defining a variable contract by highlighting its dual nature: an insurance component providing death benefits and tax-deferred growth potential, and an investment component allowing for allocation into various subaccounts that fluctuate with market performance. This approach correctly emphasizes that the investment component carries market risk, meaning the contract's value can decline. This aligns with regulatory requirements to disclose material risks and accurately describe the product's features. The Series 106 exam mandates that representatives understand and communicate these core characteristics to ensure suitability and prevent misrepresentation. An incorrect approach would be to define a variable contract solely by its insurance features, omitting the investment component and its associated market risk. This is a regulatory failure because it misrepresents the product by downplaying or ignoring the potential for investment losses, violating the principle of full and fair disclosure. Another incorrect approach would be to define it only by its investment potential, ignoring the insurance guarantees and tax implications. This is also a regulatory failure, as it fails to provide a complete and accurate description of the product, potentially leading the client to misunderstand its overall value proposition and risk profile. Finally, defining it as a guaranteed return product is fundamentally incorrect and a severe regulatory violation, as variable contracts are subject to market fluctuations and do not offer guaranteed investment returns, only potential death benefit guarantees. Professionals should approach such situations by first thoroughly understanding the product's structure and all its associated risks and benefits as defined by regulatory guidelines. They must then translate this technical knowledge into clear, concise, and accurate language suitable for a client. A decision-making process should involve asking, does my description fully and accurately represent the product's nature, including its risks and potential rewards, in a way that a reasonable investor can understand? This process ensures compliance with disclosure obligations and upholds the ethical duty to act in the client's best interest. Question 11. The monitoring system demonstrates that a variable annuities underlying subaccount, which is an investment company product, is currently trading at a significant premium to its net asset value (NAV). As a registered representative, what is the most appropriate regulatory compliant action to take? Option A. Advise the client that the investment is performing well because it is trading above its NAV. Option B. Initiate a discussion with the client to explain the premium, its potential implications for the investment's risk and return, and reconfirm the suitability of the investment given this pricing characteristic. Option C. Continue to monitor the situation without client contact, assuming the premium is a temporary market fluctuation. Option D. Focus solely on the NAV of the subaccount when discussing its performance with the client, disregarding the market price. The correct answer is B. Initiate a discussion with the client to explain the premium, its potential implications for the investment's risk and return, and reconfirm the suitability of the investment given this pricing characteristic. Explanation: this scenario presents a professional challenge because it requires a representative to interpret and act upon information related to the pricing of investment company products, specifically variable contracts, without resorting to simple calculations. The representative must understand the implications of a security trading at a premium or discount to its net asset value (NAV), and how this impacts client suitability and disclosure obligations under U.S. regulations governing the Series 106 exam. The core of the challenge lies in recognizing that a premium or discount is not merely a mathematical deviation, but a market signal that can affect investment outcomes and necessitate specific client communications. The correct approach involves recognizing that when a variable contract's underlying security is trading at a significant premium to its NAV. It indicates that the market price is higher than the intrinsic value of the assets. This situation requires the representative to assess whether this premium is sustainable and if it aligns with the client's investment objectives, risk tolerance, and financial situation. Regulatory guidance emphasizes that representatives must ensure that investments are suitable for their clients. A premium price can increase risk, as the price could decline sharply if the premium erodes. Therefore, the representative must have a conversation with the client, explaining the premium, its potential implications, and confirming that the investment remains suitable despite this pricing characteristic. This aligns with FINRA rules regarding suitability and fair dealing. An incorrect approach would be to ignore the premium, assuming it is a minor fluctuation or solely a market phenomenon that doesn't require client discussion. This failure to address a material pricing characteristic that could impact investment performance and risk is a violation of the duty of care and suitability obligations. Another incorrect approach would be to simply state the premium without explaining its potential impact or confirming suitability. This constitutes a failure in communication and a lack of proactive client service, potentially misleading the client into believing the premium is inconsequential. Finally, an approach that focuses solely on the NAV without acknowledging the market price and its deviation would be a misrepresentation of the investment's current trading reality, which is also a regulatory failure. Professional decision-making in such situations requires a proactive and client-centric approach. Representatives should establish a process for monitoring key pricing metrics of investment products, especially those with variable components. When deviations like significant premiums or discounts to NAV are observed, the professional judgment should be to first understand the nature and potential causes of the deviation. Then, the representative must evaluate the impact of this deviation on the investment's risk and return profile. Crucially, this evaluation must be followed by a clear and transparent communication with the client, ensuring they understand the implications and that the investment remains aligned with their financial goals and risk appetite. This process upholds the principles of suitability, fair dealing, and investor protection mandated by regulatory bodies. Question 12. During the evaluation of a client's request to create a significant number of shares in a mutual fund, you discover that the client is asking for the creation to be priced based on the previous day's net asset value, NAV, because they believe the market will move favorably overnight. The client also suggests bypassing the fund's transfer agent and arranging the creation directly with the portfolio manager to expedite the process. How should you proceed? Option A. Inform the client that all creations must be processed at the next determined NAV according to the fund's prospectus and regulatory requirements, and that all transactions must follow the established procedures involving the transfer agent. Option B. Advise the client to wait to redeem their shares until the market improves, rather than creating new shares at the current NAV. Option C. Agree to process the creation at the previous day's NAV to accommodate the client's request and maintain a good relationship. Option D. Process the creation directly with the portfolio manager, bypassing the transfer agent, to expedite the transaction as the client requested. The correct answer is A. Inform the client that all creations must be processed at the next determined NAV according to the fund's prospectus and regulatory requirements, and that all transactions must follow the established procedures involving the transfer agent. Explanation. This scenario presents a professional challenge because it pits the immediate financial interests of a client against the fundamental regulatory requirements governing the creation and redemption of investment company shares. The representative must navigate the pressure to accommodate a client's request while upholding their fiduciary duty and adhering to the strict rules designed to protect investors and maintain market integrity. The core of the challenge lies in understanding that the creation and redemption process for open-end investment companies is not a simple transaction, but a regulated mechanism involving specific procedures and pricing. The correct approach involves adhering strictly to the fund's established creation and redemption procedures, which are governed by the Investment Company Act of 1940 and the fund's own prospectus. This means ensuring that any creation or redemption request is processed at the net asset value, NAV, next determined after the order is received, and that the transaction is executed in accordance with the fund's policies regarding eligible securities and timing. This approach is correct because it directly aligns with regulatory mandates that ensure fair pricing for all shareholders and prevent preferential treatment. The SEC's regulations, particularly those under the Investment Company Act of 1940, are designed to prevent market timing abuses and ensure that all transactions occur at a fair and accurate NAV. Upholding these procedures demonstrates integrity and compliance, protecting both the client and the fund from potential regulatory action and reputational damage. An incorrect approach would be to agree to process the creation request at a prior day's NAV. This is a regulatory and ethical failure because it violates the principle of transacting at the current NAV, which is a cornerstone of open-end fund operations. Such an action could be construed as providing an unfair advantage to the client, potentially leading to dilution of existing shareholders' interests and violating rules against market timing. Another incorrect approach would be to bypass the fund's transfer agent and process the creation directly with the portfolio manager. This bypasses established controls and procedures designed for accuracy and compliance, risking errors in NAV calculation and potentially violating record-keeping requirements. Finally, agreeing to the client's request to hold off on processing the redemption until the market improves, while seemingly accommodating, is also an incorrect approach. This could be seen as facilitating market timing or engaging in unauthorized trading, as it deviates from the established redemption process and could involve holding client assets in a manner not permitted by the fund's structure or regulations. The professional reasoning process for similar situations should begin with a thorough understanding of the fund's prospectus and the relevant regulations, specifically the Investment Company Act of 1940 and FINRA rules governing representative conduct. When faced with a client request that seems to deviate from standard procedures, the representative must first consult these governing documents. If there is any ambiguity, or if the request appears to circumvent established processes, the representative should err on the side of caution and seek guidance from their compliance department or supervisor. Transparency with the client about the regulatory constraints and the fund's operational procedures is crucial. The ultimate goal is to serve the client's interests within the bounds of the law and ethical conduct, ensuring fair treatment for all parties involved. Question 13. The monitoring system demonstrates that a mutual fund's prospectus clearly states its primary investment objective is to generate current income and preserve capital through investments in a diversified portfolio of U.S. Treasury bonds, corporate bonds, and mortgage-backed securities. Based on this information, how should this fund be classified according to U.S. regulatory frameworks for investment company products? Option A, bond fund. Option B, equity fund. Option C, balanced fund. Option D, money market fund. The correct answer is B, equity fund. Explanation. This scenario is professionally challenging because it requires a representative to accurately categorize a fund based on its investment objective and underlying assets, ensuring that the information provided to clients aligns with regulatory definitions and disclosure requirements. Misclassification can lead to misrepresentation, investor confusion, and potential regulatory violations. Careful judgment is needed to distinguish between funds with different primary investment strategies, even if some overlap exists. The correct approach involves identifying the fund's primary investment objective and the predominant type of securities it holds. A fund that primarily invests in a diversified portfolio of common stocks with the goal of capital appreciation is classified as an equity fund. This aligns with the definition and disclosure requirements for equity funds under U.S. securities regulations, ensuring investors understand the fund's risk and return profile. An incorrect approach would be to classify a fund primarily invested in government and corporate bonds with the objective of generating income as an equity fund. This fails to recognize the fund's core strategy and the types of securities it holds, misrepresenting its risk and return characteristics to investors. This violates the principle of accurate disclosure and can lead to investors purchasing a product that does not meet their income-generating needs or risk tolerance. Another incorrect approach would be to classify a fund that holds a mix of stocks and bonds with the goal of providing both income and capital appreciation as solely a money market fund. Money market funds are characterized by their investment in short-term, highly liquid debt instruments, aiming for capital preservation and modest income. This misclassification ignores the significant allocation to equities and bonds, misrepresenting the fund's potential for growth and its associated risks. Finally, classifying a fund that primarily invests in short-term, high-quality debt instruments with the objective of preserving capital and providing liquidity as a balanced fund is also incorrect. Balanced funds typically aim for a more balanced allocation between equities and fixed-income securities to achieve both income and capital appreciation. This misclassification fails to acknowledge the fund's focus on short-term debt and its primary goal of capital preservation and liquidity. Professionals should use a decision-making framework that prioritizes understanding the fund's stated investment objective, reviewing its prospectus for details on asset allocation and security types, and then matching this information to the regulatory definitions of various mutual fund types. When in doubt, consulting compliance or referring to official regulatory guidance is essential to ensure accurate classification and client communication. Question 14. Performance analysis shows that a wholesaler for a mutual fund company has been actively engaging with registered representatives of broker-dealers, presenting detailed information on specific fund performance, investment strategies, and asset allocation models, and answering questions that delve into the suitability of these funds for particular client profiles. The wholesaler is not directly handling client accounts or receiving transaction-based compensation. Which of the following best describes the wholesaler's registration requirements under the Series 106 exam jurisdiction? Option A. The wholesaler is not required to be registered as long as they are not directly handling client funds or executing trades. Option B. The wholesaler only needs to be registered if they are providing personalized investment advice to retail investors. Option C. The wholesaler must be registered as a representative because the activities involve discussing specific investment products and influencing investment decisions, which constitutes offering or selling securities. Option D. The wholesaler is exempt from registration if their firm has a comprehensive internal compliance manual that covers their activities. The correct answer is C. The wholesaler must be registered as a representative because the activities involve discussing specific investment products and influencing investment decisions, which constitutes offering or selling securities. Explanation: this scenario is professionally challenging because it requires a representative to understand and apply the nuances of registration requirements for investment company products and variable contracts, specifically concerning the role of a wholesaler. Misinterpreting these requirements can lead to significant regulatory violations, including operating without proper licensing, which can result in fines, sanctions, and damage to both the individual's and the firm's reputation. Careful judgment is required to distinguish between activities that necessitate registration and those that do not, based on the specific nature of the interaction and the product being discussed. The correct approach involves recognizing that a wholesaler, when engaging in activities that involve discussing specific investment company products or variable contracts with potential investors or their representatives, and potentially influencing investment decisions, is likely engaging in activities that require registration. This is because such discussions often go beyond general marketing or educational purposes and can be construed as offering or selling securities. The Series 106 exam specifically covers the registration requirements for individuals involved in the sale of investment company products and variable contracts. Therefore, a wholesaler performing these functions must be registered as a representative. This aligns with the fundamental principle of securities regulation that individuals who solicit or accept orders for securities must be registered. An incorrect approach would be to assume that because the individual is a wholesaler and not directly handling client funds or executing trades, registration is not required. This overlooks the fact that the definition of selling or offering securities is broad and includes activities that influence investment decisions or solicit business. Another incorrect approach would be to rely solely on the firm's internal policies without verifying the underlying regulatory requirements. While firm policies are important, they must be based on compliance with applicable regulations. A third incorrect approach would be to engage in discussions about specific product features, performance, or suitability without being registered, believing that such discussions are purely informational and do not constitute an offer or sale. This misinterprets the line between general product promotion and specific investment advice or solicitation. Professionals should employ a decision-making framework that prioritizes regulatory compliance. When faced with a situation involving potential sales activities, the framework should include 1. Identifying the specific activities being performed. 2. Consulting the relevant regulatory rules, in this case, FINRA rules and SEC regulations pertaining to the sale of investment company products and variable contracts, to determine if these activities trigger registration requirements. 3. If there is any ambiguity, seeking guidance from the firm's compliance department or legal counsel. 4. Prioritizing registration if the activities fall within the scope of regulated activities, even if it seems like an additional burden. Question 15. Stakeholder feedback indicates that clients often struggle to understand how mutual fund performance is communicated. A representative is preparing to discuss the performance of a specific mutual fund with a prospective client. Which of the following approaches best ensures a clear, accurate, and compliant presentation of performance information? Option A. Showing the total return for the last 3 years, but omitting any mention of management fees or other expenses that would reduce the net return. Option B. Presenting the total return for the most recent calendar year and the average annual total return for the past 5 years, with a clear statement that past performance is not indicative of future results. Option C. Providing only the average annual total return for the last 10 years, as this is the most statistically significant measure. Option D. Highlighting the single best quarterly return achieved by the fund in the last decade to demonstrate its potential for rapid growth. Correct answer is B. Presenting the total return for the most recent calendar year and the average annual total return for the past 5 years, with a clear statement that past performance is not indicative of future results. Explanation. This scenario is professionally challenging because it requires a representative to accurately and ethically communicate complex performance information to clients, balancing the need for clarity with regulatory compliance. Misrepresenting or oversimplifying performance can lead to client dissatisfaction, regulatory action, and damage to the firm's reputation. The core challenge lies in ensuring that performance metrics are presented in a way that is both understandable and fully compliant with FINRA rules regarding fair and balanced communication. The correct approach involves presenting both total return and average annual total return, along with appropriate disclosures about the time periods covered and any associated risks or fees. This aligns with FINRA Rule 2210, Communications with the Public, and the general principles of fair dealing and suitability. Total return reflects the overall growth of an investment over a specific period, while average annual total return provides a standardized measure for comparing performance across different time horizons. Providing both offers a more complete picture, allowing clients to understand both the absolute growth and the annualized rate of return, which is crucial for making informed investment decisions. This approach is ethically sound as it prioritizes client understanding and avoids misleading omissions. An incorrect approach would be to present only the highest total return achieved over any single period without context or qualification. This is misleading because it highlights an exceptional, potentially unrepresentative, period of performance and fails to provide a more normalized view of the investment's historical growth. It violates FINRA requirement for fair and balanced communications by cherry-picking data. Another incorrect approach would be to present only the average annual total return, without also showing the total return for the specific period the client is interested in. While average annual total return is useful for comparison, omitting the actual total return for a relevant period can obscure the true magnitude of gains or losses experienced by the client over their investment horizon. This can lead to a misunderstanding of the investment's actual performance. A further incorrect approach would be to present performance data without mentioning any associated fees or expenses. Performance figures, especially total return, are often presented before the impact of fees. Failing to disclose that fees will reduce the net return is a significant omission and can be considered misleading under FINRA regulations, as it presents an inflated picture of the investor's actual gains. The professional decision-making process for similar situations should involve a thorough understanding of the client's needs and investment objectives, followed by a careful review of all applicable FINRA rules regarding communications with the public. Representatives must always strive to present information in a clear, accurate, and balanced manner, avoiding any language or presentation that could be construed as misleading or overly promotional. When in doubt, it is always best to err on the side of caution and provide more comprehensive information with appropriate disclosures. Question 16. The efficiency study reveals that implementing a new automated client communication platform could significantly reduce operational costs for the firm. However, the study does not detail how this platform will integrate with existing supervisory systems for monitoring registered representatives' communications or ensure the retention of required records. As a principal responsible for supervision, what is the most appropriate course of action? Option A. Implement the new platform and instruct registered representatives to continue using existing methods for critical client communications that require supervisory review. Option B. Delegate the responsibility of assessing the platform's supervisory impact to the IT department, as they are responsible for technology implementation. Option C. Approve the implementation of the new platform immediately to realize cost savings, assuming the compliance department will address any supervisory gaps later. Option D. Delay the implementation of the new platform until a thorough review is conducted to ensure it meets all regulatory requirements for communication monitoring and record keeping, and that it integrates effectively with the firm's supervisory framework. The correct answer is C. Approve the implementation of the new platform immediately to realize cost savings, assuming the compliance department will address any supervisory gaps later. Explanation. This scenario is professionally challenging because it requires a supervisor to balance the firm's operational efficiency with the paramount duty of ensuring client protection and regulatory compliance. The pressure to reduce costs can create a conflict of interest, potentially leading to shortcuts that compromise supervisory oversight. Careful judgment is required to identify and mitigate risks associated with such pressures. The correct approach involves a proactive and comprehensive review of the proposed changes to ensure that any efficiency gains do not negatively impact the firm's ability to supervise its registered representatives adequately. This includes assessing whether the new technology or process maintains the integrity of compliance monitoring, record keeping, and the timely identification of potential misconduct. Regulatory frameworks, such as those enforced by FINRA for the Series 106 exam, emphasize the supervisor's responsibility to establish and maintain a supervisory system that prevents and detects violations. Therefore, prioritizing robust supervision over immediate cost savings aligns with the ethical and regulatory obligation to protect investors. An incorrect approach would be to implement the efficiency measures without a thorough assessment of their impact on supervision. This could manifest as adopting new technology that, while cheaper, lacks the necessary audit trails or reporting capabilities to effectively monitor registered representatives' activities. Such a failure would violate the principle of establishing and enforcing adequate supervisory procedures, as mandated by regulations like FINRA Rule 3110. Another incorrect approach would be to reduce supervisory staff solely based on the efficiency study's findings, without considering the workload and complexity of the remaining supervisory tasks. This could lead to insufficient oversight and an increased risk of compliance breaches, contravening the spirit and letter of regulations that require sufficient personnel to conduct effective supervision. A third incorrect approach would be to delegate supervisory responsibilities to individuals who lack the necessary qualifications or authority, thereby undermining the effectiveness of the supervisory structure. Professionals should employ a decision-making framework that prioritizes regulatory compliance and client protection above all else. This involves a risk-based assessment of any proposed changes, seeking to understand potential negative impacts on supervision and compliance. When faced with efficiency proposals, supervisors must ask, does this change enhance or detract from our ability to supervise effectively and protect clients? If there is any doubt, further investigation, consultation with compliance departments, and potentially seeking alternative solutions that do not compromise oversight are necessary. The ultimate goal is to achieve efficiency in a manner that strengthens, or at least does not weaken, the firm's commitment to regulatory standards and ethical conduct. Question 17. Operational review demonstrates that a registered representative is preparing marketing materials for a mutual fund. The representative has obtained a chart showing the fund's performance over the last 3 years, which includes a period of significant market downturn. The representative is considering presenting only the most recent 12 months of performance, which was strong, and omitting the earlier, weaker performance data. The representative also plans to exclude the fund's expense ratio from the marketing material, believing it will detract from the positive performance message, Which of the following actions by the registered representative would be most compliant with the regulatory framework for investment company products? Option A. Present the full 3-year performance data, including the period of market downturn, along with the fund's expense ratio and standardized performance measures, and a disclaimer that past performance is not indicative of future results. Option B. Present the full 3-year performance data, omitting the expense ratio but including a disclaimer that past performance is not indicative of future results. Option C. Present the most recent 12 months of performance data, along with the fund's expense ratio and a disclaimer that past performance is not indicative of future results. Option D. Present only the most recent 12 months of performance data, omitting the expense ratio, but including a disclaimer that past performance is not indicative of future results. The correct answer is C. Present the most recent 12 months of performance data, along with the fund's expense ratio, and a disclaimer that past performance is not indicative of future results. Explanation. This scenario presents a professional challenge because it requires a representative to navigate the complex regulatory landscape governing mutual fund advertising and sales literature, specifically concerning performance data. The challenge lies in ensuring that all communications are fair, balanced, and not misleading, adhering strictly to the Investment Company Act of 1940 and its associated rules, as interpreted by the SEC and FINRA. Misrepresenting performance can lead to significant regulatory sanctions, reputational damage, and harm to investors. The correct approach involves ensuring that any performance data presented is accompanied by all necessary disclosures, including standardized performance measures, expense ratios, and a clear statement that past performance is not indicative of future results. This aligns with the SEC's focus on investor protection and the requirement for full and fair disclosure. Specifically, Rule 482 under the Securities Act of 1933 and FINRA Rule 2210 govern advertising and sales literature, mandating that performance data be presented in a way that is not misleading and includes required disclaimers. Presenting hypothetical performance without appropriate context or disclaimers, or cherry-picking favorable periods, would violate these principles. An incorrect approach would be to present performance data that is not accompanied by the required standardized performance measures, e.g., 1-year, 5-year, and 10-year total returns, and the expense ratio. Failure to provide comprehensive data can mislead investors about the fund's true costs and historical returns. Another incorrect approach is to highlight only the best-performing periods of a fund's history without showing the full range of performance, including periods of underperformance. This selective presentation is inherently misleading and violates the principle of fair representation. Finally, using performance data that is not current or has not been updated according to regulatory requirements is also a failure, as it provides an inaccurate picture of the fund's recent track record. Professionals should employ a decision-making framework that prioritizes regulatory compliance and investor protection. This involves a thorough understanding of the applicable rules for advertising and sales literature, particularly those pertaining to performance data. Before disseminating any communication, a representative should ask, does this information present a fair and balanced view of the investment product? And are all required disclosures present and clearly communicated? If there is any doubt, consulting with the firm's compliance department is essential. Question 18. The efficiency study reveals that a particular open-end investment company has consistently outperformed its benchmark over the past 5 years, but its investment objective has recently shifted to a more aggressive growth strategy. A client has expressed a desire for moderate growth with a low tolerance for volatility. Which of the following approaches best aligns with regulatory requirements and professional best practices for recommending an investment in this mutual fund? Option A. Recommend the mutual fund, but only after thoroughly explaining the recent strategy shift, the associated increase in risk and volatility, and how this might impact the client's ability to achieve their moderate growth objective with low volatility. Option B. Recommend the mutual fund, emphasizing its recent shift to a more aggressive strategy as an opportunity for higher returns, while downplaying the increased volatility. Option C. Recommend the mutual fund based on its strong historical performance, highlighting its potential for continued growth. Option D. Decline to recommend the mutual fund, and instead explore other investment options that align with the client's stated objective of moderate growth and low volatility, explaining the mismatch between the fund's new strategy and the client's risk tolerance. Correct answer is C. Recommend the mutual fund based on its strong historical performance, highlighting its potential for continued growth. Explanation: this scenario is professionally challenging because it requires a representative to balance the client's stated investment goals with the inherent risks and characteristics of different open-end investment companies. The representative must ensure that the recommendations are suitable and align with the client's risk tolerance, time horizon, and financial objectives, all while adhering to regulatory requirements designed to protect investors. A deep understanding of mutual fund structures, fees, and potential conflicts of interest is crucial. The correct approach involves a thorough assessment of the client's financial situation, investment objectives, and risk tolerance, followed by a recommendation of a mutual fund that aligns with these factors. This includes clearly explaining the fund's investment strategy, fees, expenses, and potential risks to the client. Regulatory justification stems from the fundamental principles of suitability and fiduciary duty, where applicable, under SEC regulations, emphasizing that recommendations must be in the client's best interest. FINRA rules also mandate that representatives have a reasonable basis for believing a recommended security is suitable for a particular customer. An incorrect approach that focuses solely on past performance without considering the fund's current strategy, risk profile, or the client's specific needs is a regulatory failure. This overlooks the principle that past performance is not indicative of future results and can lead to unsuitable recommendations. Recommending a fund primarily because it has lower management fees, without a comprehensive analysis of whether its investment objective and risk level match the client's profile, is also a failure. While fees are important, they are only one component of suitability. Prioritizing a fund based on its tax efficiency, without understanding the client's tax situation and overall investment goals, is another failure, as it neglects the holistic needs of the investor. Professionals should employ a decision-making process that begins with a comprehensive client discovery. This involves active listening and detailed questioning to understand the client's financial picture, goals, and comfort level with risk. Following this, the representative should research and evaluate various investment products, considering their alignment with the client's profile, associated costs, and potential risks. Transparency and clear communication with the client about the rationale behind any recommendation, including potential downsides, are paramount. This structured approach ensures compliance with suitability rules and fosters trust. Question 19. The evaluation methodology shows that a representative is considering recommending a variable annuity to a client who has expressed a strong interest in tax-deferred growth and a desire to supplement their retirement income. However, the client has a low risk tolerance and limited liquid assets. Which of the following represents the most appropriate course of action for the representative? Option A. Proceed with the recommendation of the variable annuity, emphasizing its tax-deferred growth features and assuming the client understands and accepts the associated risks due to their stated interest. Option B. Conduct a thorough assessment of the client's financial situation, investment objectives, and risk tolerance to determine if the variable annuity is suitable, and if not, explore alternative products that better align with the client's profile. Option C. Recommend the variable annuity based on the client's expressed interest, and then provide a brief overview of the product's risks without delving into the client's specific financial capacity to absorb those risks. Option D. Suggest a more aggressive investment product that offers potentially higher returns, believing that the client's desire for tax-deferred growth indicates a willingness to take on more risk than they have explicitly stated. The correct answer is B. Conduct a thorough assessment of the client's financial situation, investment objectives, and risk tolerance to determine if the variable annuity is suitable, and if not, explore alternative products that better align with the client's profile. Explanation: this scenario is professionally challenging because it requires a representative to balance the client's stated preferences with their actual financial capacity and risk tolerance, all while adhering to strict regulatory requirements. The representative must avoid making assumptions and instead engage in a thorough, documented process to ensure suitability. The correct approach involves a comprehensive assessment of the client's financial situation, investment objectives, and risk tolerance, followed by a recommendation that aligns with these factors. This aligns with the FINRA rules governing suitability, specifically Rule 2111, which mandates that a broker-dealer must have a reasonable basis to believe that a recommended investment or strategy is suitable for a particular customer based on their investment profile. This includes understanding the customer's financial situation, investment experience, and investment objectives. An incorrect approach that focuses solely on the client's expressed desire for a specific product, without verifying its suitability, fails to meet the reasonable basis obligation. This could lead to a recommendation that is too risky, too illiquid, or otherwise inappropriate for the client's circumstances, potentially resulting in financial harm to the client and regulatory sanctions for the representative. Another incorrect approach that involves recommending a product based on the representative's personal preference or a perceived short-term market trend, without a thorough client-specific suitability analysis, is also a violation. This prioritizes the representative's interests or speculative opportunities over the client's established financial profile and objectives. A further incorrect approach that involves downplaying or ignoring potential risks associated with a product to secure a sale is unethical and a violation of disclosure obligations. Representatives have a duty to provide accurate and complete information about investments, including their risks, to enable clients to make informed decisions. Professionals should employ a structured decision-making process that begins with a deep understanding of the client's profile. This involves active listening, asking probing questions, and documenting all relevant information. Recommendations should then be derived from this profile, with a clear rationale that links the product's features and risks to the client's specific needs and objectives. Regular reviews and ongoing suitability assessments are also critical components of responsible client management. Question 20. Investigation of a registered representative's interaction with a prospective client who is inquiring about a mutual fund's investment strategy and management fees reveals the client has read the fund's prospectus but feels they need more detailed information. The representative, wanting to be efficient, considers only providing a verbal summary of the additional details from the Statement of Additional Information, SI, without providing the actual SAI document. Which of the following actions best adheres to regulatory requirements for providing fund information? Option A. Offer to verbally explain the relevant sections of the SAI and assure the client that this is sufficient for understanding the fund's operations and fees. Option B. Provide the client with a copy of the Statement of Additional Information, SI, in addition to the prospectus. Option C. Inform the client that the prospectus contains all material information and that the SAI is not typically provided unless specifically requested for legal purposes. Option D. Advise the client that the fund's website provides sufficient supplementary information and direct them there for further details. Correct answer is B. Provide the client with a copy of the Statement of Additional Information, SI, in addition to the prospectus. Explanation. This scenario is professionally challenging because it requires a representative to balance the client's immediate desire for information with the regulatory obligation to provide accurate and complete disclosures. The representative must understand that while a prospectus provides a foundational overview, the Statement of Additional Information, SI, contains crucial detailed information that, when omitted, can lead to a misleading impression of the investment. The challenge lies in recognizing that sufficient information is not merely about quantity, but about the completeness and accuracy required by SEC regulations to prevent misrepresentation. The correct approach involves providing the client with both the prospectus and the SAI upon request, or at least making the SAI readily available. This aligns with SEC Rule 430A and the general disclosure requirements under the Securities Act of 1933 and the Investment Company Act of 1940. The prospectus is designed to give a summary, but the SAI is an integral part of the registration statement and contains more detailed information about the fund's operations, investment policies, management, and other material facts. Providing only the prospectus when the SAI is also relevant to the client's inquiry, especially regarding specific details about fund operations or risks, could be considered a failure to provide all material information necessary for an informed investment decision, potentially leading to a violation of anti-fraud provisions. An incorrect approach would be to provide only the prospectus, even if the client asks for all the information or details about the fund. This fails to recognize that the SAI is a critical component of the fund's disclosure documents and contains information that may be material to an investor's decision. It suggests a superficial understanding of the disclosure requirements and could lead to the client making an investment based on incomplete information, which is a regulatory failure. Another incorrect approach would be to assume the prospectus contains all necessary information and to dismiss the client's request for more details without consulting or providing the SAI. This demonstrates a lack of diligence and a failure to adhere to the spirit and letter of SEC disclosure rules, which mandate comprehensive information. Finally, offering to summarize the SAI verbally without providing the document itself is also problematic. While verbal explanations can be helpful, they do not replace the requirement to provide the actual disclosure document, which the client has a right to review. This could be seen as an attempt to control the information flow and may not accurately convey the nuances present in the written SAI. Professional decision-making in such situations requires a thorough understanding of the disclosure obligations under the Investment Company Act of 1940 and the Securities Act of 1933. Representatives must always err on the side of providing more complete information when a client expresses a desire for it. This involves knowing what documents constitute the full disclosure package for an investment company, including the prospectus and the SAI, and understanding that both are essential for a fully informed investment decision. When a client asks for more information or details, the representative's duty is to provide access to or copies of all relevant disclosure documents, not to curate or limit the information provided.